Good evening, ladies and gentlemen. Thank you for joining us tonight. This webinar is proudly brought to you by Bursa Academy, where you can unlock a world of financial learning. Bursa Academy is a comprehensive platform that aims to provide investors with a continuous and holistic learning journey. You may access Bursa Academy by scanning the QR code on your screen now, or by entering www.bursaacademy.bursamarketplace.com. The topic for tonight's webinar is building a defensive portfolio during unpredictable times. So, ladies and gentlemen, before we continue, I need to ask everyone's microphone is turned off. We would like to avoid any disruptions during this presentation. Questions will be open to you through the chat feature in the Zoom platform, and they will be addressed by the panelists after their presentation. During the Q&A session, please tag your questions by mentioning your name, where you're from, the question, and to whom the question is addressed to. I repeat, you may type your questions in the chat feature. Please make sure you tag your questions by mentioning your name, where you're from, the question, and to whom the question is addressed to. Our panelists for the evening are Rushdi, Siddiqui and SYED ALWI bin MOHAMED SULTAN. So Rushdi is the co-founder and CEO of iPortal. Rushdi has been recognized as one of the top 50 global Islamic finance personalities, 2015-2019 Islamica500.com. Rushdi led the team that created the world's Dow Jones Islamic Market Index, including Islamic Sustainability Index, and led the team at Thomson Reuters to create the world's first Islamic interbank benchmark overnight rate. Rushdi is a former advisor at Wall Street Blockchain Alliance, former member on the Islamic Finance Advisory Board of Dubai International Finance Center, also a former member on Malaysia Securities Commission's International Islamic Advisory Committee, and a former mentor at McKinsey YLA in Malaysia, and an advisory board member at Malaysia-based IFN FinTech. Rushdi is currently leading the efforts for launch of a global Islamic economy, education, and application platform, connecting ambition to knowledge to action in Malaysia. Introducing SYED. SYED is the Managing Director of ABC Strategy SDN PhD. SYED is an experienced C-suite Islamic banker with more than 22 years of professional experience in the financial services and consulting industry. SYED held the position of President and Chief Executive Officer of Agrobank, Malaysia's premier development financial institution, focused on the agriculture industry, and Managing Director and Regional Head of Islamic Finance at BNP Paribas, Malaysia. He was Director of Islamic Organization at Standard Chartered Siddiqui, Executive Vice President of Strategic Planning at Bank Muamalat Malaysia. SYED is the Managing Director of ABC Strategy and is a leading columnist in iPortal, covering topics on Islamic finance and social finance. Without further ado, I will give the floor to Siddiqui to start the presentation. Siddiqui, you may share your screen.
Thank you, Rian. Bismillahirrahmanirrahim. Assalamu alaikum wa rahmatullahi wa barakatuh. And a very good evening. Welcome to this webinar organized by Bursa Academy. Thank you, Rian, for your kind introduction. Let me start the session with an overarching statement that the COVID-19 pandemic has disrupted and disconfigured the contours of our behavior and our way of life. It has caused damage to economies, businesses, and livelihoods. We all know that countries are battling the pandemic on two fronts: a humanitarian battle to save lives, livelihoods, well-being of society, And another front is the economic battle to restore the economy, businesses, jobs, trade flows, and financial assets, such as the stock market. So to start the session, I would like to invite Dr. Rushdi Siddiqui to offer us an overview of the state of affairs of the global economy and global financial markets. Dr. Rushdi, would you like to share your slides?
Yes, assalamu alaikum all. It's a pleasure and an honor for me to be here on a Friday evening in Malaysia. I'm from New York, Friday early morning. Thank you for taking time out from your busy schedules to share your time with us. And we hope that it'll be a fruitful time spent together. We're not here to talk about strategies with respect to stock market investor. What we're here to talk about is an awareness. That is probably the most important and fundamental understanding of what an investor, whether you're a novice or a seasoned or in between, need to understand. So this is the slide, and this is about shocks, and shocks are external shocks and how they impact our lives, our livelihoods, and things associated with this. So the external factors that affect a stock market causes uncertainty. Businesses do not like uncertainty. And so the key issue becomes, how do you deal with uncertainty in the frame of mind of trying to be business as normal? So we know about viruses and diseases as an external shocks, but there are also elections. The United States has just gone through the elections, and I'm sure you're reading the news about what's going on. So that's an external shock. It creates an uncertainty in the marketplace. Economic and financial crisis, trade agreements, they cause uncertainty. Conflicts and wars, they cause uncertainty. And one of the ongoing uncertainties that is in the middle of people's mind, that is becoming at the forefront of the mind and will be for the next several decades, is climate change. This is a long laundry list. Each has a certain weight of what it produces on businesses and collectively on the stock exchange, which is a proxy of how the investment community views how their dollars are being spent, consumed, and invested. So the key issue here is understanding the following, that how do you react to uncertainty, right? What are the early warning signs? What are the safe harbors? Do you buy on dips, meaning when the market goes down, or do you basically stand back and stay steady? These are fundamental issues that one has to look at when they are looking at being a potential investor. The chart that you see in front of you is basically from 1970 to November to January of this year, which talked about the coronavirus. You see in each of the cases, the 1 month, 3 months, and 6 months, and on average with respect to these external shocks, you see the market eventually recovering. If you look at the November figures of the stock market in the United States, when the vaccine was announced, the market was up, I believe, north of 10%. So one must be adherent to what their philosophy is and understand external shocks, but not overreact to external shocks. That's part and parcel of the way the real world works. It's how you react to it. If we can go to the next slide, please. Okay. So in building a defensive portfolio, the key issue is understanding who are you, male or female. Male and female, if you look at data, look at risk differently. Females have a tendency, supported by data, to be more risk conscious. Doesn't matter what the age is. So That's one of the insights that data has shown over time. Second is, how old are you? You know, when you have few responsibilities and are making money, then you can be more aggressive with respect to where you're going to park your money, right? The key issue here on the money is you've worked hard or working hard for your money. Now you want your money to work hard for you. And where should it go so it can produce returns, right? As you get older, then your risk tolerance becomes an area that you're more conscious of. You become more risk averse because you've got obligations, and those obligations are fixed. And therefore, if you have a portfolio and that portfolio addresses your lifestyle and obligations, you have to have certainty to it. Level of education, apologize for the three bubbles, but again, the more educated you are, generally speaking, you are prone to make less mistakes. But having said that, there are very smart people who basically have not done well on market timing. But the point here is the more you know, the more informed you are, and that you could make a better decision. That's basically the consensus. Do you understand business cycles? Do you understand that this may be the beginning of the business cycle? So what does your portfolio look like or should look like? And we'll get into that. Where do you live? If you live in the G20 countries versus the emerging markets, in a developed country and even an advanced developing country like Malaysia, though not a G20 countries, you have options to where you can have your money work for you. In the frontier markets and emerging markets, you have less options. So therefore, if you are an investor with less options, you will have oftentimes a very volatile portfolio. If things are going well, you will make a lot of money. If they're not going as well, you will not make as much money as you expect. And the last point here is, how do you view risk? And risk is a function of who you are, where you live, what your level of education is, and what your investment objectives are. The more you understand this about who you are, what stage of life you're at, and this is an ongoing review. So this basically allows us to better understand what our expectations are in having our money managed. If we can go to the next slide, please. So in building a defensive portfolio, this is an elaboration of the previous slide. Knowing yourself. I cannot emphasize to you often enough, if you don't really know yourself and not being honest with yourself, then you will be prone to making emotional mistakes, and those can cost you money at the end of the day. Stage of life, rebalancing, you have to remove emotions away from the process of investing. If you have a process and the process is ongoing and it's refined over time, then you have a rules of engagement as the market goes up and down. And that basically allows you to better understand how you view the market and then how you interact with the market. Stage of life. As a young person, few obligations, married with children, more obligations, children preparing for their education, their marriage, so you start setting money aside. And then you have to look at, is your money working for you to address these obligations for your children and grandchildren? Extremely important. And excuse me, defensive. At the end of the day, the markets will not continue to rise always. External shocks, business cycles, sectors, whether it's a financial sector, or whether it's the utilities, whether it's technology, they basically move. Whether they move aligned to the markets is another issue, but nonetheless, they move. Investment objectives. Again, if you live in a country where you have a variety of investment opportunities as alternatives, then you have a better opportunity to basically manage your portfolio with less volatility. Volatility is oftentimes something that people are not comfortable with. That's why you see in many of the emerging markets, you have more depositors than you have investors in the marketplace. For a number of reasons, but one of the most important reasons is people want to be able to drive by their investments. People want to be able to hold and touch and feel the investment, and having money in a bank as a deposit allows them to have that source of comfort. Business cycle, we'll get into that. Understanding early warning signs of where we are in the business cycle is very important, and understanding what those warning signs are is extremely important for you to understand and its implications. And diversifying risk. All of these points are dots onto themselves, but you have to look at them as, how do I connect the dots so I understand what I am trying to establish with respect to my expectations. Next, please. Okay. So we talked about portfolios, right? An aggressive portfolio has the characteristics often associated with young people with minimum fixed obligations. They may be living with their parents. They may be living with a bunch of their colleagues. And as time goes forward, in terms of the aging process, as you get older, you have more obligations, your risk tolerance basically evolves until you reach a certain age. The point here is, this may seem logical if you think about it, but very few people understand it, because everyone wants to basically have a portfolio with minimal risk and high returns. At the end of the day, the psyche is that, especially for people who are less educated in understanding the marketplace and how it works. You know, they talk about, I would love to have something that's fast, that's cheap, and that's good. It's very difficult to have all three of those things. And so you wind up having two of the three, right? The slide portion to the right is basically addressing allocation models based upon external shocks, where a moderate investor and a conservative investor basically reevaluate their portfolio. And the area that they focus in on is where it's risk and where there's reduced risk. If you look at the fixed income space, there's reduced risk, especially in the AAA paper. And if you look at small cap stocks, especially small cap stocks in emerging markets, there's more risk. So you focus in on areas where the risk is high in terms of revising a portfolio based upon external shocks, and you look at areas where the risk is manageable, more stable, and you allocate accordingly. So this may seem like something that's logical. It is, but you've got to put thought to paper. The paper becomes your rules of engagement, and then you've got to enforce those rules of engagement and remove the emotional association with respect to how you react to markets based upon external shocks. Next, please. So now we went from a high level, right, at almost a jet view of 42,000 feet. Now we're going to a helicopter view where we're starting to understand that a stock market has economic sectors, and those economic sectors typically are 10 sectors, and those sectors are anywhere from healthcare to energy to technology, but those sectors, based upon historical data, are broken down into defensive areas, which one can call safe harbor, and cyclical areas, meaning those that basically react to the economy, and there's a little bit more volatility. The defensive sectors, they basically at times may be called old economy companies within old economy sectors, such as utilities, for example. They pay out a dividend, which is one of the things that makes them attractive. And then when you look at new economy companies, such as the technology companies are more volatile and they pay out obviously very little dividends. The excess surpluses are pushed back into the company for operations, expansion, so on and so forth. What's interesting in this COVID environment is the technology sector has become a defensive sector. If you look at, and we'll show this to you, the performance of the technology sector of the S&P 500 from December 2019 to November 4th, 2020, you will see its outperformance against other sectors. You will see its outperformance against the S&P 500. The point here is, do you understand that the technology sector, which is often part of the new economy, at times, under certain and ideal circumstances, may become a defensive sector? So next, please. So this pie chart talks about asset being economic sector allocation. And oftentimes, stock market indexes are based upon market capitalization. And the market capitalization is basically a formula / methodology of the prices of the shares multiplied by what the free float is at times, meaning the number of shares outstanding. And what happens here is basically as certain sectors start becoming in demand, such as the technology sector, you see its weighting increasing because the share prices are increasing, right? So what you have are certain biases during certain economic cycles where the technology sector may lead the stock market, or the energy sector may lead the stock market, or the banking sector may lead the stock market because their market capitalization is much larger. Therefore, it can pull the market, but you also have sell-offs in the market where it can pull down the markets. So other sectors which may be performing well because the companies in those sectors are doing well may be pulled down for no reason of their own, but because of the sentiments of the contingent effect or the sell-offs. So one must be conscious of these type of issues when investing. Next, please. So what this is about is understanding performance. So if we look at the S&P 500, which is a broad market index for the United States and at times proxy for the world at large, because of the weighting that the US stock market capitalization has compared to other markets, it being the largest economy today in the world. We see a number of things on the chart to the left. So we see the 10 sectors of the S&P indexes. We see the underperformance at the very bottom of energy and finance and real estate, which makes sense if you take a step back and look at how banks who've been exposed to businesses and how those businesses are doing. Have banks resulted in non-performing loans and potential write-offs, so that's affecting them, right? So now we have a better understanding of that. The energy sector, businesses are closing, the oil prices, there's less demand for it because fewer cars on the road, fewer planes in the air, so on and so forth. And so that has a multiplier effect. It makes sense that during this time period that the energy sector, the financial sector, the real estate sector has underperformed S&P 500, which is the black line right through the middle. At the very top, you see outperformance from two expected sectors: technology sector, which became a defensive harbor, if you will. Unusual times results in at times unusual outcomes, and consumers, consumer sectors, whether discretionary, whether it's staples, or whether it's services, they have outperformed. Now, what's interesting here is if you look at the correlations of the sectors, you see the dips that took place in March. That's when the coronavirus basically became a global phenomenon. And then during the course of time between June and July, you see the markets basically moving up. And then you see another spike basically towards the end of September. What's interesting here is certain sectors have not recovered from December 2019, and those sectors are what we had talked about, which is energy, finance, and real estate. So this gives us an understanding of behavior of the market economic sectors being outperforming, which is technology, which is consumer sector, and underperforming, which is energy, finance, and real estate. Now, the graph to the right basically blows up those particular stocks from Amazon, Apple, Facebook, Microsoft, Google to the S&P 500. These have outperformed. These have outperformed because of it being viewed as a safe harbor. So this herd mentality comes into play. That's one of the areas. And then the technology sector is part of the new normal. And the poster child of the new normal is Zoom. We're all Zooming, there's Zoom fatigue. But before COVID-19, people used to Skype, right? FaceTime, Cisco WebEx. Now everyone talks about Zoom, whether it's an international conference of political leaders, business leaders, webinars, seminars, it's always Zoom. So obviously the market capitalization of Zoom has skyrocketed. And I believe the founder, his net worth is about $20 billion because of this. So in crisis comes opportunities, and some of them are fortuitous, meaning they just happen. Others are basically better planned in real time. For example, the grocery delivery area. In the United States, it is doing quite well. There's actually consolidation taking place because the weaker delivery startups have not been able to meet expectations on demand. And so the bigger ones have taken advantage of that. If we can go to the next one, please. So here we had talked about business cycles and how we should view the business cycle, right? Because the business cycle is basically what the stock markets work under. If you take a step back and look at listed companies, their businesses, and collectively the listed companies become the stock market. So the stock market becomes a sentiment of how business is being viewed from a confidence point of view. Now, if we look at companies in trying to understand what areas are captured by early in the business cycle, the graph to the left basically talks about financials and real estate, consumer discretionary information technology. These, according to this set of data, are early business cycle opportunities. And so as we move from mid-cycle to late cycle, it's self-explanatory. The point here is, what is the early warning sign for what's on the road ahead, right? And what are the technology companies doing during the pandemic-19? You've got these big companies from Google to Microsoft to Facebook to Amazon. They are so big now that at times it becomes difficult for them to grow organically. So they are growing by way of acquisitions and acquisition of startups. And some that basically is an opportunity for us to think about, how do we look at companies that are publicly listed who have been knocked down in terms of their value? Are they good value investment opportunities? Next, please. So this is basically looking at risk from the point of view of a stairway. The bottom of the stairs is basically a safe harbor, if you will, where you're focusing on money market, defensive sectors, so on and so forth. And as we move up, and based upon our objectives and what we want our money to do with us, you see the risk profile of asset classes increasing. Therefore, the reward is also increasing proportionately. And it goes all the way to the money market. I'm cognizant of our time to ask questions, so obviously these slides are available for your own consumption. If we can go on to the next one, please. So what we want to talk about here from a transitioning point of view is you've got market declines. In market declines, what sectors do typically well? We had talked about safe harbors and we had talked about safe sectors. This data showcases, for example, in the area of consumer staples, utilities, healthcare, telecom services, that these sectors have outperformed better than the S&P 500 in market declines. Market declines is different from market shocks, right? Where the COVID-19 is a market shock opportunity. So that becomes at times an outlier. We're focusing on market declines. If we can go to the next one, please. So as we go from the secular to the spiritual, Islamic investing, Malaysia is one of the global thought leaders and actual leaders in Islamic finance, banking, and investment. It has the largest number of Sharia compliant stocks listed on Bursa Malaysia. It has the largest number of Islamic funds globally, according to the recent data. So Malaysia is a reference point when we talk about Islamic investing. Now, if we take a step back and look at the whole screening process of Islamic investing, we see that it's actually a defensive sector play, and we'll get into that, that it's actually conservative investing. We'll get into that. And if we were to define the negative screening of Islamic equity investing, it's low debt, non-financial, social, ethical investing. When you have this type of screening, it results in certain biases towards the healthcare sector, biases towards energy sector, bias towards technology sector. When those sectors are doing well, then the Islamic equity indexes will outperform. But when the conventional financial sector is doing well, in the Islamic screening, the conventional financial sector is insignificant because banks, insurance companies, conventional banks, insurance companies, asset managers cannot be in an Islamic equity index because it violates the primary screen. The boxes that I've circled or squared basically talk about how in 2008, when we had the financial crisis, the MSCI World Islamic Index outperformed its conventional counterparts for 4 years. And to the top right, it showcases Islamic investing has underperformed in this time period because of the heavy exposure to the energy sector. And we saw from a previous slide that the energy sector has not done well at all during this COVID financial crisis. But the Islamic equity investing screening has removed the financial sector. So as we saw, the financial sector was one of the laggards from December 2019 to November 4th, 2020. Islamic equity screening does not have exposure to that, so it missed out on being further pulled down. And if we look at the top 10 constituents of the MSCI World Index, 5 of the 10 are in the healthcare sector, which we saw previously as being a defensive sector, and 2 of the 10 are in the consumer staples, which were top performing, as we saw in the previous slide with respect to the different sectors. Next, please. So this is a further deeper dive into Islamic investing with respect to values and momentum and quality of balance sheet. Amongst all these areas, I think the quality of the sound balance sheet is probably extremely important. And if you look at the way it's presented on the chart to the left, where the blue actually represents a box. You see how far the box has gone towards the right, from neutral to overweighting. And if you look at the MSCI World, which is that smaller dot in that box, the screening has resulted in better quality identified by balance sheet compliant stocks. So these are some insights that the screening has resulted with respect to Islamic equity investing. Next, please. So if we can click one more time, please. So we talk about exposure to a diversified asset classes. We know about publicly listed companies, we know about bonds, we know about cash. So that's a typical portfolio. But as you have an understanding of different asset classes, and those asset classes are available and accessible to you, such as startups, then you basically can do more things with your portfolio. This is information from iPortal. This is under the entrepreneurship tab, and iPortal is live, so feel free to see this information yourself. If we go to the Malaysia startup page, here are the list of social impact startups from Malaysia. This will allow you to look at potential investment opportunities in the startups in Malaysia. It's an exciting opportunity to look at. Whether one does something is another issue, but the opportunity to look at makes this, I think, a very exciting place because the startups will be part of the knowledge-based economy aspirations of Malaysia in their Vision 2025, 2030 plans. Next, please. So this is the last slide. This is basically the characteristics of defensive portfolio. As you can see, the slide to the left is a more traditional defensive portfolio of stocks, international, domestic, foreign bonds, domestic bonds, high quality bonds, short term. And to the right is a more exotic, diversified asset classes where you're looking at exposure to P2P lending, exposure to REITs, exposure to life insurance. So in effect, understanding what a defensive portfolio is about understanding who you are, what stage of life you're at, and what your investment objectives are. As I've said before, you've worked hard for your money or working hard for your money. Now you want your money to work hard for you. So with that, thank you for your time. Very much appreciated. Back to you, Syed.
Sure. Thank you, Dr. Rushdi. Let me try to summarize very quickly some of your salient points, and then I will quickly look at the questions and answers. We have two questions already posed. But before that, so effectively building a portfolio of defensive stocks or companies requires first and foremost knowing the risk appetite and suitability of the investor. So as you said, Rushdi, understanding ourselves in terms of our risk appetite and what our tolerance levels are. So that's A. B, knowing the difference between cyclical and non-cyclical or aggressive and defensive stocks, and how these stocks change during different crises. So that's the second part. The third point is finding high quality companies that actually have strong fundamentals and strategies for value creation. And you mentioned Zoom as one example, which is a company that is enjoying opportunities during this crisis, and hence is creating value from their services and offerings. So number four, strong management and solid cash flows and reserves and buffers are important in identifying companies that can sustain and withstand any downturn in an economic crisis. and finally having a dynamic mindset to regularly rebalance the portfolio or the portfolio's asset allocation, diversifying across various sectors and countries, across bonds, stocks, and cash securities is important in building a portfolio of defensive strategies during a time of crisis. So that sort of summarizes the key points from your presentation. I like to quickly go to the questions raised by Nishad from Malaysia. The first question is, Rushdi, what do you think is the portfolio to invest during the pandemic? And Nishad's second question is, what stocks under technology is a safe portfolio to invest in during the pandemic and after the pandemic? You touched upon this in some of your slides. The questions I noticed was posed before you spoke about the slides, but probably Rushdi, you'd like to just respond to this again?
Right. The key issue is I am not in the position to advise on portfolio companies and portfolio construction because that's not the purpose of this particular webinar. What we wanted to do is basically create an awareness of how to view external shocks, such as the COVID-19 pandemic, and its implication on the business cycle and businesses, and that collectively on the stock market, right? In taking that approach, there are opportunities to look at companies who have been downtrodden, meaning they've been hit hard in the financial sector, the real estate sector, and the energy sector, as we've identified from the S&P sector indexes. Within those particular sectors, there are companies that have got good balance sheets, right? It's just the market sentiment has resulted in their sell-off. So they become value stocks. It's up to you to basically say, okay, I'm comfortable with the sector. I understand these names. Then I will go forward and deploy some of my investments and savings into these areas. So you've got to have a process-driven approach to this. You cannot and should not and are not encouraged to invest in companies that you know nothing about, right? You're in Malaysia. Would you invest in companies in Canada if you knew nothing about that? You may have heard some news about Canada and how the market is doing and their reaction to the COVID-19, so on and so forth. But you may have a telecom company in Canada and a telecom company that you're familiar with in Malaysia. Where would you invest? So that's an extremely important point. With respect to the technology sector and what are, quote unquote, the gems, you have to also understand, has the upside been taken from any further appreciation, right? Because you are a late investor in the technology space, for example, and therefore your pop, meaning your additional rise, is minimal, right? The people who got into the technology sector earlier, they took that risk and they were rewarded with that risk, Zoom being one example. But those who are getting to Zoom now, their upside is limited because the market has priced in the value of that particular stock. Hopefully that answers the question.
Okay. With a bit more time that we have, let me ask you this question, Rushdi. You see, one of the biggest aberrations, if I can use that term, that has left investors confused and bewildered during this period of pandemic is that the S&P 500 continued to rally ever since its crash in late March. If I can recall, March 23rd was when it crashed, when the pandemic started becoming, or was declared a pandemic, and started freaking out investors. But since then, the S&P 500 has gone on a rally, despite the growing number of unfortunate deaths, despite not finding a vaccine only until recently, despite GDPs crashing, recessionary economic situations taking place, the S&P continued to rally. What can explain that? And at the same time, the reasons that what do you call specialists or strategists have tried to explain that phenomenon, that rally didn't replicate in other stock markets. Why has it not been seen in other markets as such? What are your views and thoughts on that?
Thank you. That's a good question. It's a tough question, and everyone has a hypothesis, right? So if we look at the technology sector, the healthcare sector, and the consumer sector in the S&P 500, they have a large weight on the S&P 500. And if you have a large weight, then you're basically performing, right? So if the S&P 500 had a large weighting in the energy financial sector, then it would have been pulled down. So the sector basically became bigger in weighting because more people went into the technology sector, bought into it. So the weightings increased in those sectors. And because of the disproportionate weighting that happened in those sectors, it pulled up the S&P 500. And to me, that makes sense. Right, the consumer sector, consumer staples, consumer services, and consumer discretionary, an important part of the COVID-19 environment. You see what's happening with online shopping, with grocery delivery, right? Retail, healthcare sector, the Pfizers and others working on the vaccine. There's a lot of excitement on the upside. And then the technology sector, we saw what Amazon, and you look at what Amazon is doing with respect to sales. They're building more warehouses. So if we break down the observations into sub-observations, we see why there is performance, quote unquote, outperformance of the S&P 500, where in an external shock of the pandemic 19, we would think that there would be a recession / depression. That's not the case. Where we go from here is probably the more important issue. Will these sectors which have done very well, will they go back to their norm, and the other sectors which have been downtrodden, will they go back up to their norm? That's where your risk appetite, your view of the marketplace comes into play in looking at how your money is going to work for you.
Okay, good, thank you. I can see that there are new participants just joining in. Just to recap, you mentioned about faith-based investing, and you specifically mentioned about Islamic investing. So at this point, for the participants, just to get more questions to come through, I like the participants who are listening to this or who managed to listen to Rushdi's presentation on Islamic investing to type in your comments to this question. Do you think ethical investing, or Islamic investing for that matter, is just a marketing gimmick, or do you think it is an important consideration in building your portfolio? And within ethical, I will define that to mean investment processes that take into account investors' personal values, not only religious values, but also environmental concerns and social concerns. So I repeat the question and I invite the participants to type in your comments or questions. Do you think ethical investing that concerns values such as concerns on the environment or social or religious requirements or concerns is just a marketing fad, a passing gimmick, or do you think it is an important consideration in building your portfolio? So while you answer those questions, I will ask another question for Rushdi to consider. You see, in a perfect world, a good investment strategy might be to buy cyclical stocks at the start of an economic expansion and sell them just before a recession begins. So now with news uh, that give us a glimmer of hope that a vaccine might be available, or is already available, in fact, but a glimmer of hope that life may return to normal or start returning to what it used to be pre-COVID. Is this a right time to start being aggressive with cyclical stocks as we build our portfolio of investments? Rushdi, what do you think?
It goes to how you view your risk and what stage of your life you are. So if you're thinking about this from the point of view of, is this a Zoom opportunity, right? The vaccine of these established companies, I believe the first vaccine was given in the UK yesterday. And the first one was an elderly lady, and she became an instant star.
And William Shakespeare.
William Shakespeare, exactly. He's aged well. The point here is, do you view these downtrodden stocks as a Zoom opportunity? Do you view these healthcare pharmaceutical stocks as a Zoom opportunity? Zoom was a startup, for lack of a better phrase, a private company / startup, went public, and market capitalization just zoomed, no pun intended, because everyone was using it. Right place, right time, and you cannot really plan this. It's one of those external positive shocks. If one were to say, I will set aside some money and I will look at the three sectors that have been downtrodden, because these are good companies based on fundamentals, and that they will go back to their norm as the new norm becomes the mean, right? That's one way of thinking about it. I say it all comes down to your hypothesis, right? I can't, and I will not share what my hypothesis is, because I'm not in the position, nor will I want to be in a position to give advice to anyone. These are just my personal issues, but I would like people to think about how to approach the opportunity and not as a challenge that has only downside. Think about, is this a Zoom opportunity? That's the way you got to think about this, but do it based upon a fundamental analysis versus an emotional reaction only. Yes, say 90% you're there with your fundamental analysis and all the research and the data that you've absorbed. And then there's that remaining 10%. You will never have 100% information to make an informed decision. Not the way life works. You will have at best 80, 70%. The rest of it has to come from your experience and gut feel. If your experience and gut feel says, yeah, this makes sense, then take a certain amount of money that you're willing to potentially lose as part of your exposure to those companies in those sectors.
Okay. And I would also say, in addition to the gut feel, a pinch of luck, because no one would have expected or anticipated an event, a pandemic of these proportions, right?
Correct.
But again, that's man proposes, God disposes, as the saying goes.
Yes, correct.
So I like to just shift your attention to, I mean, building a portfolio of defensive stocks or defensive portfolio also concerns diversifying into other classes of investments or assets, including debt, including bonds or sukuk.
Right.
And during this pandemic, governments have taken very strong measures to tackle their economic problems using the internal reserves. And the question is, what impact would the huge debt of governments to tackle the economy have on stock market performance? This is in relation to allocation of scarce liquidity between subscribing to government debt against investing in the stock market. So obviously there are going to be, if there are already governments issuing bonds to raise funds as part of their monetary policy measures to tackle the economy. How would investors react between investing in these government debt and investing in the stock market?
A tough question, to be honest with you. If you look at what we call priming the pump, these stimulus programs, right? The US had a massive stimulus program. We're looking by way of Congress to have another one where checks were given to the public at large, where loans were given at favorable rates to the SMEs because they're the backbone. And that cushioned some of the downside risks to a certain degree, right? So the stimulus program actually helped increase consumer spending, and consumer spending is about 2/3 of the GDP in the United States, right? So that's one aspect. But if you also look at stock market indexes, the currency value, the sovereign debt, foreign direct investments, these are other things that one has to be conscious of. If we look at, for example, Malaysia, from February until now, removing the political element out of the equation for now, Malaysia unprecedented, a massive stimulus program. Has it provided a buffer? Because things could have gotten worse. The order that limited movement, companies that are delivering food and online e-commerce platforms. So the silver lining, if one can find a silver lining in this horrible COVID crisis of impacting families, unfortunately, there are some opportunities, and those opportunities have produced gigantic returns. Now, those gigantic returns, are they a reflection of government foresight? Probably not. It's just fortuitous. So stimulus program impacted the consumer sector. And at the same time, if that supported the stock market, as in the case in the US, then there seems to be a level of confidence. Money typically moves towards confidence because it avoids uncertainty. So money probably came in from overseas into the US market, into those sectors, right? Again, these are our hypotheses, and I think 6 months from now, when the data that is verified and available, we'll be able to draw a picture of what actually happened. Difficult to do it in real time right now.
Okay. So thank you, Rushdi. I think we have reached the end of the session. There are no further questions, no takers for the point that I mentioned just now on faith-based or ethical investing, but that's all right. Would you like to summarize your session, or sorry, would you like to say your last words in conclusion?
Right. Right. I think the takeaway message is you have to be an optimist, right? Because the sun sets, but it also rises. I think if we view the road ahead, what the world would look like, I think that this whole crisis has made us at least more conscious, more aware, more educated. At least I am. I understand vaccines and all this other stuff than I did 9 months ago. So I look at things differently now, and I would hope that others would start looking at things, whether it's relationships, whether it's families, whether it's markets, whether it's jobs, whether it's the government, a bit differently in light of what we've gone through. Defensive portfolio doesn't mean the stock market itself. It's how we also view life. We can't live in a shelter, in a cave. Life has to go on. The new normal will probably be more online, and therefore, if you are not online, then you're not connecting to your customer.
Okay.
So thank you.
Thank you, Dr. Rushdi. Let us all put our hands and hearts together in thanking Dr. Rushdi for a very informative presentation. Thank you. And I now hand back to the organizers. Rian, back to you. Thank you.
Thank you, Syed. Thank you, Dr. Rushdi. With that, we have come to the end of tonight's webinar. Firstly, we want to say thank you to the audience once again for joining this webinar tonight. I know it's Friday and it's late night. And thank you to Rushdi and Syed for sharing your insights and thoughts on building a defensive portfolio during unpredictable times. This webinar will also be available on www.bursaacademy.bursamarketplace.com for your preview again. With that, I wish everyone a safe and happy weekend. Good night.